The other banking options: banks versus building societies, banks and credit unions. From students at Exeter University. Banks in the United Kingdom are generally big institutions. In the UK, we have 5 big players in the banking market. Key facts about the financial landscape of the United Kingdom. The commercial banking sector creates 97% of the money supply in the United Kingdom. Only 3% of the UK's banks are local banks. The number of high street branches has decreased by 43% in the past 20 years. Small and medium-sized enterprises account for 80% of UK employment. High street banks in the UK have 95% of the market share. So that's some information about the general banking sector. Now let's talk a little bit more about banks. So banks have shares. So a person wants to buy a share and they buy a section of the bank. This means that a bank has lots and lots of different owners who all want some profit. So why do banks do this? Banks sell shares in order to create capital. Capital then allows the banks to go about their day-to-day business and operate as usual. Because of their size, it means that the banks can operate on an international scale, investing internationally. Because of this, banks use more money than they actually have, a bit like a credit card. This means some banks have taken too much risk, causing what happened in the financial crisis. So, what do banks offer? They offer a range of different services, from current accounts, savings, loans, mortgages, along with insurance and lots of other services. So, building societies. Facts about building societies. The first was set up in 1775. In the 80s, banks became competitors. The big 4 in the UK are Nationwide, Yorkshire, Skipton and Coventry. Unlike banks, they have no shareholders. This means they are owned by their customers, their members, meaning that the members get the profits. They get this through high saving rates and low mortgage rates, allowing them to invest long term. They offer a range of different services, current accounts and savings mainly, and also loans, and focusing on mortgages. Some act as umbrellas for smaller building societies, having merged during the financial crisis. Yorkshire and Nationwide are 2 examples of this. So what restrictions are placed on building societies? The nature limits are set out in the Building Societies Act. 75% of their assets must be in residential land. Also, 50% of their capital must be from savings. They also can only operate in the UK, but this means they are allowed to specialise in the UK market, meaning that they are one of the best and biggest mortgage providers. Customer satisfaction is very high for building societies, 71% of savers being happy and 72% of mortgage holders.
So credit unions, they're mutuals, meaning they're owned by their members. They're also run by a board of volunteers. They are community-based as legislation, meaning members must have a common bond, and this bond must be between no more than 2 million people. So this can be geographical or through employers, for example. They give dividends to members, not interest rates. So the profits go directly to members. So the non-profit organizations. So what do they offer? Mainly savings and loans. Also starting to offer payday loans. This is good for customers, as APR is capped at 26.8% rather than the 4,000% that internet providers charge. They promote financial inclusion, allowing all access to financial services. London Mutual and London Community Credit Union are examples where this is their primary goal. They also majorly support small to medium-sized businesses, which is something banks and building societies don't do as much. Overall, credit unions are more community-focused. Thank you for watching.
We hope that you feel more informed about
Banks
credit unions
and building societies.